Unique insights often come from insiders who have experienced a real problem in their own industry and have realized they have a unique insight in the way to fix it. The flip side of this is founders that have come into industries they don't know, approaching a problem from a very different perspective. And the reality is, if you solve those hard problems, that's where you get the big outcomes. It's understanding the pitch that you're playing on. The difference between today and 2020 is less capital around, there's more discipline. Each company really needs to look at its own ability to raise. If you have a solution and you're confident that you can raise a lot of capital, or if you've had really strong indications, you can spend more capital. If not, you have to be a little bit more careful.
We adopted, in a way, this power law model. What are your views on it?
We've talked before about the power law, that the returns are often driven by a very, very small number of companies in that portfolio. If you have a business model that can bring an outsized return, you need to, in your pitch and in your experience, excite the investor about the possibilities. It's about understanding that North Star in 5 or 10 years.
How do you go about unpacking that? Because a lot of founders struggle in communicating that.
Yeah, I think it.
Welcome to the pod. Welcome to the pod. Barry, I was looking forward to this one. The man, the legend. You know, we've come across a couple of things, right? I would say through the years that we've gone deep into sessions. And I say we have to bring it to the world, right? Barry, so welcome to the pod. Really looking forward to this conversation.
Thanks, Hesus.
So when people don't know you, Barry, right? You know, as I said, we've been crossing roads, crossing paths, doing a couple of things together, right? Barry, just tell them, you know, your background, right? And how you ended up a bit into venture capital, right?
Yeah,
I think that's
I guess my background is a combination of law and banking over about 20 years. And then a pivot, like many founders or many people in the venture ecosystem, I pivoted into kind of early stage investing, angel investing, and a real interest in technology about 10 years ago. Mm-hmm. And through different roles, working with different companies, working in syndicates. I'm now at Elkstone, which is an early stage technology investor based here in Dublin. I'm a venture partner there since 2022, and responsible for kind of a little bit on the origination side, but a lot of helping and supporting our portfolio companies in terms of plugging in advisors, sitting on boards, and that side of things. So really get a lot of energy out of it, and always enjoyed our interactions over the years. I think we probably met 6 or 7 or 8 years ago. I can't even remember in your different roles.
Yeah, we were hacking together, right? You know, the long nights. We don't talk about the work-life balance because we'd have no work-life balance.
100%, yeah, deadly.
Back then. So Barry, tell the audience, if you don't mind, a bit of your journey, because I think your journey is incredible. I want to spend just a small time there, right? Because you went from law to venture capital. Before that, you were in England doing a couple of things as well. It's been a very, very interesting journey. Just from outside, just listening in a couple of the other podcasts that you spoke about it, I thought it's a very interesting journey for anyone to get inspired.
As I said, I pivoted. I kind of studied law originally. In Trinity, and kind of effectively qualified as a lawyer, but I found myself more drawn into the banking side of things. So worked in Citibank, an American bank based in London, for about 11 years in different roles, in legal roles and structured finance roles. I got married, had 3 kids in England, came back to work for a Dutch bank, kind of leading a financial innovation team. And when I was there, I began to see that financial innovation was more in a bank, some legacy systems and a lot of Excel, and I was beginning to get more and more interested in the technology universe that was out there. And again, a phrase I've used a long time. I decided I'm either the old person in the room who knows a bit about tech, or the old person in the room who knows nothing about tech. So I went back to school, did some kind of top-up degree in technology, and that was really my real interest in kind of the startup ecosystem. I didn't know how I could be involved, but it was really trying to get the blend of a financial experience that I had and, I guess, a technology interest, and fusing those together. So that could have been at a startup, but I didn't really have a passionate idea or scalable idea I wanted to work on. And so the investing side was the natural place. And it's a supremely interesting area. You get a chance to meet all of these great people doing great things, and mentally it's a huge challenge in terms of kind of trying to keep up, as you know, with all of the changes that are going on out there.
Let's jump straight away into it then, Barry. What for you is a venture ready business, right? Because that means a lot of things to a lot of people. And I love when you workshop it and you break it down to basics, right? From an African entrepreneurs, where you've worked with two cohorts now, right? Because a venture ready business should mean the exact same thing in any given market, right?
Yeah, so I think I always, when I am answering this question, I always, remind people that most of the businesses that we see on the high street or when we go out of our front doors or in our businesses are not venture businesses. So there's very particular set of characteristics that are required to be a venture ready business. But I also add that that doesn't mean that if you're not a venture ready business, you're not building a great business, because there's
Exactly.
lots of different ways to build great businesses. And often that's through bank loans or through profits or through traditional other forms of financing. So getting a venture investment is not success in itself. It means that you have a business model that matches effectively what a venture investor is looking for. Now, usually there's a number of different characteristics. So that's a great team with a unique insight, tackling probably a really big problem, or they have the insight to see that there's a big problem or a big opportunity that can be tackled down the road. And that business usually requires not just a single amount of capital, but in its capital journey will require more and more capital to expand, because usually you found a really efficient way to expand in revenue or expand in users or expand in technology. So really understanding, and we've talked about this before, the idea of everyone knows about a business model, but understanding the capital business model of your business. Are you efficient? And also, as you are working with a venture firm or working with venture companies, really their job is to really, in many cases, get you to the next round of capital to be able to expand the business more. And that's simply not every business that can do that, and that's really important to understand. So we say no to a lot of people, not because it's a bad business, it's just not a business that works for the capital model that we have.
I love the part that you broke it before you even move into the financial element of this, the multiple rounds, the sequencing, right? Because at the end of the day, you have to look at the lens of the venture capitalist, your seat, right? Because at the end of the day, you have a fiduciary duty to the people that gave you the money, right?
Yeah.
So you have to look at how you potentially get that exit. But I want to potentially dip down now, initially, Barry, on the unique insight, right? Because this is the part I feel sometimes we always call the point of view, that how do you look at the unique insight for you? Or is it defensibility as well? What level of defensibility, right? Because that unique insight is so key now, even in the era of AI.
Yeah, and often a unique insight comes from, well, I guess there's two different sides of this. One, unique insights often come from insiders who have a very have experienced something, have experienced a real problem in their own industry, and have realized that that's a big problem, and that they have a unique insight in the way to fix it. And that's very helpful in terms of if you come from a particular industry as well, particularly around go-to-market and other matters down the road, having that domain expertise is very helpful. So people talk about product market fit, but there is founder product fit or founder market
Yes.
fit as well, and that's a separate area to look at. So having a unique insight in an industry that you know can be very helpful. Now, the flip side of this is there's a lot of successful founders that have come into industries they don't know, and in some ways, because they're approaching a problem from a very different perspective, that in itself actually means that what were considered legacy barriers are no longer considered legacy barriers. But I think that's a kind of a different way of attacking an individual problem. But having unique insight, I think is very powerful to defensibility, or to the ability to be able to scale the business. In many ways, with technology, defensibility is getting less and less, and it's become a tougher and tougher area to effectively jump across. Now, if you are in very, very deep in a kind of deep tech, a unique insight, unique technology, that effectively can be a real superpower as well there. So there's different ways of having that unique insight, either by the people that are, coalesced around the problem and the experience of those people, with the ability to be able to build a solution, or something that's really, really, really difficult and you're tackling at a kind of an early stage. And the reality is, hard problems are the problems that result in, if you solve those hard problems, that's where you get the big outcomes. If life was about people making a load of money solving easy problems, there'd be a lot more people with a lot more
Rich.
money. Or yeah, so I think that's also something that, if it's something that's been done a million times before, or it's just harder to build a case that can be an outsized income or outsized outcome. And that's something, again, I didn't touch on. Venture capital investors are investing in a number of, a significant number of different companies, often out of a fund where they might have 30 companies in that. And we've talked before about the power law, the fact that
Yes.
the returns of venture are often driven by a very, very small number of companies in that portfolio that have a very, very sizable outcome in terms of multiple of capital invested. And I think if you are not a business that can create that outcome, you're less likely to attract a venture investor, because the venture investor is looking ideally for 30 different possibilities of a very high outcome. And we know that that's very risky. And we know that 50%, 60%, 70% of those companies, unfortunately, may not make it all the way, or may not give the returns ultimately that the investor is looking for, but can still, in some cases, bring value, obviously, to the portfolio return for the ultimate investors. But it's understanding that if you have a business model that can bring an outsized return, that is what the investor is talking about. And you need to, in your pitch and in your experience, excite the investor about the possibilities, not about what's happening right now. It's about that really understanding that North Star in 5 or 10 years.
Well, that's brilliant. But I knew this was really, really great, because there's two things that we actually we don't talk about too much in the startup ecosystem, right? One is that the founder problem fit, because coming back to you said that majority of the time you do have to have that domain knowledge to be able to transform the industry, particularly if you go into a B2B motion. Go to market motion. You need that insight to know how the stakeholders, approach conversations and things, right? So it's really great that the audience got that perspective. And then deep diving now of the venture model, right? Because we adopted in a way as well this power law model from US. What are your views on it? Is it the right model now? It works, right? But it's just like democracy, right?
In terms of the kind of San Francisco capital model, model?
Yeah, that model is in the power law. We do, do the bets, spread the bets out. Hopefully 1 or 2 give us the returns of the fund, and recycle and do it again, right?
Yeah, I think, I still think there's elements of it that are the same, at least in the hope for outcomes. And if you look at the amount of capital that's gone into, let's say, whether it's ChatGPT or foundation models, where there's a huge amount of capital have gone into an area where it's not clear what the value will be in LLMs, or indeed whether there's room for 10 or 15 or even just 1 or 2 of those, or maybe only one that will survive. So there's a lot of people behaving in that similar way in terms of capital. I think the difference at the moment between today and, let's say, 2020, 2021, 2022 is there is less capital around. That is 100% true. There's more discipline around pricing. In some cases, there's more discipline. In a small number of cases, there's an absolute absence of discipline. I think the big difference was probably in the 20s, there was a general absence of discipline, if that's possible, in that everything was priced more aggressively. Whereas today, I think if you're for some of the foundation and other AI plays, the pricing on those rounds and the amount of capital that's available into those companies is absolutely huge. And but if you're not in those spaces, I think the power law still applies. And I think it's really trying to find that niche that you can really mine. And understanding, and this is the tricky bit, that there can be a balance between kind of burning cash, which was what used to happen in the old days, where the old days being the 2020s, where effectively everything is about growth,
Land
and
grab.
whereas today unit economics are important, and trying to build in some flexibility to have some control over your destiny is also part of that narrative. But I'm really conscious that all of those together, there's a lot of things that actually fundamentally disagree in there in terms of the capital journey. So each company really needs to look at its own position, its own ability to raise. If you have a problem and a solution, and you're confident that you can raise a lot of capital, or if you've had really strong indications, you can spend more capital. If not, you have to be a little bit more careful. And I think one of the key issues from a founder perspective is really, really understanding the capital journey of your business. Again, something we've talked about before, and understanding the real metrics that an investor is looking for at different stages. So at Elkstone, we're investing, I guess, pre-seed, seed, and pre-A, and in other cases. So we have 60 companies in our portfolio. We have a fund, 100 million fund based here in Ireland, investing in early stage companies at that pre-seed, seed, and pre-A. But at each point, we're looking at different metrics to evaluate whether the company has made progress. And as you get later in terms of Series A and Series B, that's much more important to understand. Not what we want as the investor coming in, it's what the next investor wants. And our job is to try and work with the founder company and the founders to try and build to those metrics that let's say Series A investor wants.
I have the vision, but how do I turn these things into a reality?
Well, it's actually simpler than you think. Have you heard of Bob AI?
Bob AI is actually like having a team of strategists in your pocket. You can create a business plan in a matter of seconds.
With Bob AI, it feels like I've unlocked the codes to business success.
Bob, make your venture builder more efficient, one idea at a time. No, the thing, Barry, that's one of the common pitfalls, right, of entrepreneurs when they go and meet you. They say, "Hey, Barry, I have this vision," but they have no idea of the unit economics, right?
Yes.
Is it one of the common pitfalls that you see, or are there other common pitfalls that we can unpack here?
Yeah, and I think understanding the unit economics, or in some cases where it's not a unit economic game, it's a user game, or it's a deep tech game, or a game may not be the right word, but it's understanding the pitch that you're playing on. And if you're a deep tech, you need more you need more capital to build your technology. So if you're a medical device company, you build your tech out of university, let's say in an Irish context, and then you're bringing that technology generally to the FDA in the States for an approval for that effectively that technology to go live in people or in whatever the other context. That's a long journey before you even get to the go-to-market part of that. So the patterns that we're looking at in that case is very different to a B2B software company that is, it gets 2 million euros to build its technology, and then really needs to show that they can build something and get enough traction and enough buyer interest at different levels to show that you're solving a real problem. And then as you go further on there into, kind of earlier stage, let's say into Series A, it's really understanding that you've built a repeatable sales pattern, that you have built that you know how you can find your customers, you know the cost of finding those customers, you know how to sell those customers, and you know that with the application of capital into that business, you can rinse and repeat and make that happen again and again. And that is ultimately really the measure in, let's say, in software, at least in terms of where you're looking at a commercialization, that understanding those unit economics, and that is really what the later investors are focusing on, is super important. And it's just something that is sometimes just not appreciated at the stage of the investor, or at the stage of the founder, where there's an overinvestment in technology and an underinvestment in actually the go-to-market part of that business. And it's a hard circle to square, but it's a super important factor in terms of what a successful early stage company is. It's understanding whether the metrics are as I say, whether it's commercial traction, whether it's if you're a game and it's users, or it's a B2C, it's a number of customers and you're selling ad revenue. Really understanding those drivers are critically important in terms of attracting that capital. And I might just jump to one other point which is relevant, right?
Yep.
When we're looking at kind of meeting with early stage founders, we always ask, do you have a data room? So, a data room is the collection of material that's really important for, and it can be the financial model, it can be pitch deck, it can be the key contracts of the company. It's effectively kind of the place that the investor goes to look to kind of evaluate the business at a very basic level, excluding the people. And we'll come back to that in another second. And we often understand, we get big financial models and we understand that. And when we're at an early stage, the key issue that we're looking at in a financial model is, well, firstly, how much cash the business needs and how much cash is projected before you have to raise again, which is in our companies. The more important actual part of the model is not the output of the model, it's the inputs into the model. It's do you understand, again, the drivers of value in your business? Do you understand if you put more into marketing that we would expect more to come out of more to come out of revenue? And if it doesn't, or if your model doesn't perform like that, it shows that it's not joined up thinking in terms of the unit economics. And we also know at super early stages that the model is, there's a huge amount of assumptions in there, but it's understanding those assumptions is really, really important there.
Yeah, there's two things I want to unpack there, Barry. One is where you talked about understanding the game you're playing, right? And also being able to convey your business to an investor in that game that you're playing, that you understand that game. As you said, if you're playing a game of deep tech, you say, hey, these are the number of steps that we need to take, and these are potentially the number of exit points for an investor. Because do you find that the entrepreneurs at times, they say, are these investors taking 15% of my business, 20% of my business? But it's an offer at the end of the day, right? You're presenting the business for a sale, right? That should generate an outcome, right? So there was an exercise that used to be done in the past. Okay, show me the exit. How big is the exit? What market do you think you're going to exit? Who do you think is going to acquire you? Because starting with that end in mind, sometimes you can play it back and say, hey, these are the 10 steps that might happen for an exit. And it might not be perfect, but it's a kind of a roadmap, right? I found those you're saying, are they disciplined enough to do that exercise?
Well, there's a few things there. Firstly, in terms of, the exit slide is a funny one because sometimes founders, we say, like, what are your plans? And they respond to us, we want to get out in 3 or 5 years. And we don't actually want to get out in 3 or 5 years. We want to be on a journey with a company, probably 5 to 10 years or longer, because you can't create generally enough value in the business in that short of a period of time for the investor to get a return. They get the return. So I think understanding that there is an exit, but we don't, understanding that in terms of exit or players in that market, that knowledge is important for us to know and for us to understand that the founder knows it. But our focus is on an exit down the road. But I do think, as I say, when I kind of mentor people, I say, do you have a North Star? Do you have a 5-year North Star? And that doesn't need to be exit. That needs to be building a great business. And then you need to effectively draw, ideally, a straight line back to today. And you need to build logically to that North Star. And I think one of the problems is that people can get distracted. They can get distracted by a single customer that weaves you off that's a very common kind of distraction. And it may be that you're pulling off in a different direction to get that customer because you need that customer or you need revenue. And that's fine unless you keep doing it or you're doing it without discipline, as long as you come back on track to where your line is to the North Star. Or if you're bringing in a customer that's non-core, you're still building technology that can be used for ultimately what you see as your core customer. So that idea of discipline on what you're building, when you're building, is really important. The flip side in the early stage universe, as you know, is that people are often pivoting at different stages and the plan has to change. And actually, we don't, we're involved in those pivots. We don't mind if it's the pivot in the right direction, and we don't mind even if it's a North Star, but then you still need to be disciplined against that North Star. So again, it sounds old-fashioned and it sounds a bit boring, but I think in a world of finite capital, which all of our companies, all of these companies, you need to, you only have really two variables. You have time and capital, and you need to use your time efficiently, and you need to use your capital efficiently. And every dollar or every euro you spend needs to either go to preservation of the business, so revenue, or to building that story for another investor to say this is amazing. And that's why my job is way easier than being a founder, because we get to invest in 30 companies, and each, these are huge challenges for founders as well, right? And it is a people game, and that's something we maybe touched on a little earlier, and it's something that I think founders need to appreciate. At pre-seed and seed, at this early stage, we're investing, in great people. It's a huge part of what we're doing. Great people solving great problems. But I think if that problem disappears, great people will find another, something else. Or if a pivot is required, there's other ways to tackle that. Non-great people, whatever that means, tackling a great problem are less likely to succeed. It's just, I think we know that people, particularly if they're second-time founders, is also very helpful. People who've done things before, but understanding that when we're evaluating an early-stage investment, a huge amount of that is based off a team, ideally, and a balanced team of let's say in our world, a technologist and a hustler, let's say, or as one example, or a combination of that in 2 or 3 people. And then just noting that when for solo founders, it's a tougher journey to have all of those skill sets in a single person on the one hand, but also to have the resilience to keep going. This is hard. Startups is not like fun time, right? It's not fun time. It's kind of a little bit sexy. That's fine, I get it. But it's, I say to people, don't do it. I say you're going to sack your friend and you're going to be sick. And so just to see what happens, because it's really, really very, very difficult. And we try to have empathy for the founders on that journey and try and help with that. But in the end, it's a lonely journey with some great upside. But we all know people who just didn't make it through and then have pivoted. I think it's a great experience for people, but I think serious people founders need to be very serious about how hard this is, and very serious about how disciplined they need to be. And we need to be disciplined in other ways to make it a success.
I want to double click on that after, because we've glorified the ecosystem a lot, right? With these beers and pizza, kind of thing, and unicorn, moonshot. Eventually it's a hard game, and that's why it makes it interesting for people that have that resilience and those unique insights and really want to make a change and impact in the world. I want to talk about the people, right, Barry, because the people aspect, and we talked so many times around this, right? It was, of course, it's about the tech, right? But someone has to go sell that tech, right? Sometimes you get that unique skill set that the individual has both, right? Well, we've seen great companies, you need that balance. Maybe now the sales motion is getting the kudos it deserves, right? Because before it didn't used to get the kudos, right?
No.
As you said, it's those hustlers.
Yeah, and I do think, like, we could talk about culturally in Ireland. I think historically, I'm not sure, just the value and importance of sales, I just don't think was really that appreciated as a culture here in some ways, because we have a very large professional class, teachers, lawyers, people who are kind of usually not selling. Whereas now, I think, whenever I've lost money in investing, it's not because people didn't build what they were meant to build. It's that they couldn't sell what they could build.
Yes.
Or they didn't have time. They spent too much money on the building and not enough time on the selling, and they ran out of road. Or in some cases they just built the wrong thing. That's true, but usually it's just not understanding or appreciating the complexity of building a marketing engine, building a sales engine, and actually that there's the theory behind what you're doing, but also the operational implementation of a marketing strategy or a sales strategy. It's hard. It's science. It's an art, and it's a specialist area. And I think, really if you're starting a business and you're not a salesperson, bringing somebody in who can help will firstly increase hopefully the chance of you succeeding more generally, but certainly the chance of you raising external capital if you have a balanced team. And that's just, again, but that go-to-market piece is so important.
So I always felt like, to be a salesperson, as you said, is a skill set, it's a profession, right?
Yeah, 100%.
Barry, because it takes a lot of enough empathy to be able to understand the buyer, understand the pain points, to be able to empathize, then translate that into a product, right? I always felt back, we spoke very passionately about it, that a good salesperson, really is invaluable to the business, because a researcher, a salesperson is automatically a researcher for your business in a way, right? But
it's very hard as well hiring salespeople is just very, very hard because they're good salespeople. Yeah, so they can sell themselves very well. So, and those early hires, and we try and really help at Elkstone, helping our companies with those early hires, are really tricky. Pulling in somebody from a very large US multinational to go in on the ground, having to build playbooks and having to do that's not for everybody. As indeed, this whole startup world is not for everybody, because you can't be precious about what you can't be precious about what you do. You have to kind of do everything, and that's if you've been in one of the big US multinationals and you've been getting free donuts for 12 years, it's a bit tricky to kind of have to go out and buy your latte again or whatever. So it's a different and that's no criticism of the people, the people in getting the free donuts. I think well done. They paid very well. That's brilliant. But I just think coming down into the trenches with a founder and having to kind of cold call again, or build a playbook, or figure out what your marketing motion is, figure out all these different things that you have to do. It's really hard, and it's not for everybody. So if anyone out there is from a big company thinking of working for a small company, take it very serious. I was going to say, don't do it. You'll be sick. You'll sack your friend, but I can't keep saying that the whole time. But I think you have to be very serious about what you can do and understand what you don't know. Because if you are in a larger company and you're at 0.7 on the sales channel, your probability of closing should be 70% or 80% already. So if you're doing that, the machine has been set up to do that. But going in, at an early stage, it's very tricky and a very, very difficult hire for the first time founders, or for founders generally, which is why having that skill set within the team is quite powerful.
Oh, big time, Barry, because coming back to you mentioned there, right, being able to roll up the sleeves and do the job as well, right? You have to start writing the playbooks now, right? You have to put the processes and the systems in place, the whole different ballgame. But when I think about you, Barry, I always think about you, the empathetic venture capitalist person, right? Well, I think it comes back to your background. You really can empathize with the founders, right? And as you mentioned there, the resilience, you feel for the people in the game. Right?
I do. Yeah, I don't know. Yeah, I'm not sure if all of the founders think I'm the empathetic.
Maybe when you give them the hard news. Maybe when you give them the hard news.
Well, look, it's not. I think. So do I think? Sorry. Do I think about what the founder experience is? Yes, I do. Yes, I do. And I think it's really hard. And have I seen it hard on people? Yes, I have. Have I seen people go through it and then come out the other side loads of times and come out, and staying in the startup ecosystem and doing an amazing job? I've seen that as well. I think, but from our perspective, I think one of the challenges when we invest in early stage companies, we also ideally want to follow on with our follow-on investing in those companies. And that second decision of will you give more money to a company is actually a much harder decision than the first decision. You'd expect it to be easier in some ways, but it's actually harder because the pool of companies that are eligible for that is a lot tighter. And I think that's where it's because we say no so many times as well, right? We say no. So I think I'd like to think I have empathy, but I'm not sure if everyone agrees that's how I am. But,
It's the balance, everything, right?
Yeah.
Barry, but can I ask you, was that one of the aha moments, right? Where you say, okay, I got to start looking more into the founders' side of the coin, right? Is that been there's been a story that, of course, in an anonymized way you can share with us that really changed your perspective in investing, right? Because what has been your journey and your different light bulbs?
Yeah, I think it is, and resilience is a word that's overused to an extent. So I guess when I started angel investing, it felt a little bit like the fairy dust went, you sprinkle the fairy dust and then everything's going to go okay. And it just isn't like that. And something I mentioned, I think angel investing is a great thing to do. But I do think if people are looking at it, pace yourself, do it, invest in a fund can be helpful, or be disciplined, saying I'm going to do 20 of these investments over 4 years, and I'm going to do 5 a year or 6 a year or whatever you're going to do, because you're learning all the way there. But certainly, how hard it is on founders, that was an I was going to say, I'm not sure if it's an aha moment or an oh no moment, actually. Yeah, it's supremely difficult. Because there's so many things that a founder has to build the tech, sell the tech, and then do fundraising. Fundraising alone, like I'm doing this, I'm investing 30 years. I'm doing, let's say, early stage technology for 10 years, and I'm learning all the time. It's tricky stuff. So having a founder who's doing their first fundraise, having to understand everything, understand documentation, understand a huge amount of learning there. And I think certainly that, in terms of an aha moment, that it's a people business, much more so was an aha moment that I realized over time, and just over kind of the study of venture, which I'm kind of interested in. The go-to-market piece, the underestimating of how difficult it is to bring a product to market was a mistake I would have probably made myself. And I think founders and again, a lot of my experiences in Ireland, but I think founders kind of at least present that as something that it's easy, underestimate how difficult that can be. It's really tricky, and there's so many elements in terms of balancing that. And then I guess the final piece is really that I use that language, that the understanding the capital journey as well as the business plan journey, or really being understanding that ultimately a lot of this investing is metric based was a bit of an aha moment. Again, that's probably a little naive. And then the other one is that, that if you're an angel investor, you'll probably need to have some follow-on capital to back up your initial investing. And that's also a very hard check to write, because sometimes, you're the only person in the room, and you grew close to the person. But statistically, the business is still, the likelihood of it getting through is very low. And the question is, are you going to write a check there? It's difficult. It's very, very difficult. But I'm not sure if they're aha moments or kind of random insights.
I love it, because I think we're going to take a segment now and do the oh no moment.
Oh no moment.
I'm gonna take that one off you now, Barry. You're gonna inspire us.
You can do that. You can trademark that
for the next ones. Barry, when you look at other markets, right? You probably you mentioned Europe, EU, UK, right? But in Africa, I see how you really come into the room, you light up, they really unpack a lot of value. When you think about emerging markets, is there an opportunity right there really to bridge how capital works there, right? Because it's very tough to build in developed Western markets, right? Building in emerging markets is even tougher, right? If the entrepreneurial game is tough all around, but it is really challenging at times when you don't have all the pieces in place, right? Sometimes we can take for granted.
I love working with your cohorts that you bring up from whether it's Nigeria, South Africa, or the different cohorts that I've had a chance to kind of engage with. And look, and they're building great. yeah, I don't like the phrase emerging markets, but that's maybe, it's a phrase that I remember when I was in Citibank, and I remember Poland was an emerging market, right?
Yes.
Or Czech Republic. I went there and it was like, this is an emerging market. People seem to forget that if you look at Africa, or if you look at Indonesia, some of these countries in the so-called emerging markets are enormous, enormous countries. The Nigerian financial system, let's say, there's fintechs, the payments rails across Africa through mobile is absolutely the cutting edge of how you can do things. So I think from my experience working with the guys, a lot of it looks like an absence of capital a lot of the time, I think, in the absence. And I guess this kind of blend between people trying to do really hard things and not being able to get capital, or the venture ecosystem not willing to bet on those, and then the depth of that capital not being there. But what I would say is, I describe people who don't know Ireland, I say that's an island in the middle of nowhere. Like, we're, from a capital perspective, we're not perfect at all, right? I think we're reasonably well served at an earlier stage. We also suffer from, kind of an absence of capital in A and B, or kind of at some of our later stage. And I think when I speaking to the kind of some of your African cohorts, I think there's challenges around capital, but the ambition seems to be there, and they do have some advantages of having a large, like if you're Nigerian or if you're South African, you're in a large market, you're in a large consumer market or other market. Whereas if you're a consumer business starting out of Ireland, it's too small of a market to make that a success. So I think each market is different, but that capital constraint is a challenge, but it's also something that exists here to an extent as well.
I couldn't agree more. The nuances, right? The African market is a risk again, and the depth of capital you bank on, a barrier. Hopefully, the market will continue evolving, right? Because you're right. Remember when you go to Poland and you're like, "Hey, it's emerging now." You go to it, looks like New York. Certain parts of it, right? Yeah. But to double click on that, an island in particular, right? Barry, where do you think the opportunity is for Ireland at the moment? Everyone's on AI vibe, AI, a team as a big team, right? Where do you think Ireland can actually play and potentially win, in your view?
Yeah, and look, I was thinking about, I actually read something today, which I was amazed that Ireland has I think the most number of STEM graduates of, is it 28 countries in Europe, which was it kind of took me back in terms of, science and technology, that we're actually producing graduate. I think we have a strong education system, so that's still there. Look, I think when we look at AI, and look, we're investing in AI, we've invested in a number of AI companies, but it's a very difficult space, where a lot of capital is pushed into, mostly in the States, into foundational models and a number of different areas, and kind of to an extent in Europe. So we've seen a number of very, very strong companies coming out. We'd probably like to see a little bit more. I think the opportunity for me in Ireland, and again, I think about this a lot. If you look at the translation of foreign and direct investment into the early stage, the outstanding example in Ireland is medical device and medtech. And this is often in Galway and Cork, and not necessarily Dublin centric, interestingly, but there's a little bit. You've had some amazing companies, US companies like Medtronic or other companies, where people have spun out of those companies. The university have been very, very aligned in BioInnovate and other strategies to make that work, and has produced a significant number of effectively deep tech opportunities. I think what is maybe a little disappointing is that if you look at the very, very large technology companies that are based in Ireland, whether it's the Googles or whether it's the, when we have, Apple, Facebook, we have all these other companies, I think there's less of a transition of those people out into the ecosystem. There's some good work being done in NDRC and the Dogpatch guys around the Founders Program or other programs there. So it would be nice to see more of that. I'm not sure what more we can do, but I think the tech ecosystem is dramatically changing. AI is changing. I'm basically addicted to podcasts, and the more I listen around AI, the more radical the way we work will be changing. So many unpredictable things. I think, there's still a strength in producing science. People with science backgrounds. There's still a kind of an interesting area where, the one thing AI can't really do is creativity, and that and we have I think in Ireland we have some superpowers around creativity, around writing, around the verbal tradition. So I think that's interesting. But in the end, it's not about pointing to people and saying this is what's going to happen here. I think it's ultimately it will be around great people solving real problems that can at scale. And that is something that I think you can do from anywhere, whether it's from Ireland or Africa or anywhere, and maybe even more so now with what's happening with AI. I think from a government perspective or from a tax perspective, there's a lot of things that we need to do to make that easier. We've some good supports from Enterprise Ireland and some of the other work being done, Scale Ireland, and other people doing some good stuff there. But the government really needs to make it easier for people from a tax perspective to take entrepreneurial risk and make that of real value. And that's something that I've been hearing the same thing for 10 years. And if we, in this current world where we have foreign and direct investment could dry up because of what's happening across the States or otherwise, Indigenous companies are the future here from an Irish perspective, and Elkstone wants to be part of that. I personally, that's why I'm doing what I do. I love the fact that you work with companies. I'm about to go on a board meeting now with a company that's grown from, I saw the guys in NDRC in probably 2018, and there's 65 people in 32 countries working for them. Like that's astonishing.
Nice.
To be some way a small part of that journey. So there's loads. I think there's plenty more to be done, plenty more problems to be solved, and hopefully you and I'll still be hanging in there trying to do some good stuff and probably make a few quid along the way.
100%, Barry. I'm going to go to the joke about the lattes, right? That piggybacking on the earlier joke, because it showed me the incentives, and I'll show you the outcome, right? If
Yes.
you're in a big tech company in Ireland, you earn and fight well, so it's, as you said, it's a risk. It's a risky game with a different
It is
appetite.
risky, but there's some good people coming out and making that kind of happen now.
Barry, what would be the advice, apart from everything that we've covered, that you will give an aspiring entrepreneur that wants to build a business that is potentially counterintuitive, right?
Whether it's counterintuitive or not, as I say, when I left school and college, we weren't allowed to have dreams, so we couldn't afford to dream. I do think, I think following doing something that you're passionate about when you're doing a startup is a huge part of that. I think doing something that matters to you or matters from a societal perspective, I think is hugely important, in the sense that it's going to be so hard that if you don't really, really want to do it, it's going to be hard to do it really, really well. So having and again, we all get passion from different things, but really, really showing passion in what you're building. And from an investor perspective, we can feel that, and we can feel energy. It's very important for people to bring energy into a pitch, or energy to a VC when you're discussing that. And I think that energy comes from inside and from passion. So maybe I'm making myself sound like I don't know, Gen Z, or a kind of somebody in touch with my feelings finally. So many people will be surprised.
See, I told you.
Many people will be surprised that I'm in touch with my feelings. But no, I think that's probably the best thing. If you find something you love, and if you can, but also find a really big problem, and if you can match those two and you pull a team together, then I think you can do some great things.
As I said, Barry, there was empathy there. Really appreciate the time, Barry. Where can people find you? I guess LinkedIn, right?
Yeah. Feel free to link out. Yeah, that's totally fine. And look, you're doing great stuff as well. So I'm looking forward to your next cohort, hopefully coming up and kind of grilling them on the power law and all the other stuff that we do too.
Thanks again for the time, Barry. That's the pod.